Once those light bulbs start to hit in here, you guys will all realize that I seem prescient and I don't. I have tricks. You just need to know this basic shit. And yes, I'm sorry. It is basic for finance people. And that's what's so fucked up and why they make so much money off of you is because they don't explain it like this. They don't want you to know. We're going to talk today about VIX futures, why it's a good risk analysis tool, and how you can use it to help de-risk or up the risk on your portfolio. And we're going to talk about how VIX futures are constructed, how to use VIX Central to kind of tell what may happen, and some of the mistakes that we did because we took live money and we played it. I think that we're also going to go into appropriate hedges now that we've learned a little bit more about how to use it. I still think it was a good and useful tool, especially in this recent drop. So I think it'll be cool to check it out. Okay. So first off, we're going to talk about what VIX futures are. So we're going to explain to you the turd onion that is VIX and volatility, because it can get really complicated, but it's a really simple topic. Let's go. So what is the VIX? Okay, it is a risk indicator for the market. It is also a measure of the volatility of the market. Basically, they go and they calculate, they go look at all the premium on SPX, which is the S&P 500 index, and they measure the prices of the options, or they measure the prices of the premium, and they say how expensive they are, right? Meaning if they're expensive, it's because a lot of people are demanding to buy it, right? Either they're hedging, or they're using it to protect a portfolio, or they're taking on risk, right? So typically what we'll see is on VIX, which is the index of the premium of S&P 500, because there's a lot of layers, right? So SPX is an index, so you can't buy it, right? You have to get the options on it. So you can go here and see SPX. So I know you guys are usually familiar in looking up SPY, but that's a fund that represents S&P 500. To go more direct to it, you go to SPX and you find all the premiums. So they go in and they calculate the premium that's been happening on this. The reason why it's not popular is because SPX is a very large product. You can see right here, if you click it, if you do confirm and send, it's a $7,500 trade. So it's a bigger trade versus SPY, which is a tinier trade, only $793. So it's almost 10 times bigger. Yes, there are also European style options. That's a great point. The VIX is the measure of the SPX options. So what you'll see is when the S&P 500 index goes down, you'll usually, and this is not always, you'll see VIX go up. When you see the S&P 500 go up, you'll see VIX go down. Because people are weird, right? They are more afraid of down movement than they are the volatility of an up movement. Is that surprising to anybody else? It should be, right? Because if VIX is just the measure of the premium that's being bought, then technically VIX should go up when S&P goes up a lot, but it doesn't. People are afraid. It's kind of, that's a reason why it's called the fear index. Is it a function of volume and premium? What it is let's say an option, let's say a put option. They go all along the strikes, and it's a complicated calculation, but basically the VIX will go up if you long this put and it's $10. In this scenario, right, the put is like $20 for that one put, right? When VIX goes down, the put is less expensive. It's like $10. So what it means is that the VIX is also an index of how much fear there is in the market, because typically what people do when they have a lot of fear is they go buy a bunch of puts, right? They're scared of further down movement, so they go buy more puts. And so that's why it's called the fear index. People are afraid, right? Because what are the emotions when you guys see Tesla go to 1,000, let's say? You all are going to be happy, right? What's your emotions when Tesla goes down to 600? Everyone's freaking out today. It's a down market today. Everyone's freaking the fuck out. We literally just had this amount of movement a week ago, but everyone's freaking out today for some reason. So now this is why it's a turd onion, okay? Because there's layers upon layers to understand the risk indicator that I'm showing you, I guess. Basically, you guys are going to learn so much about every product. And yes, I'm going to gloss over some of that, but we can discuss that later. So now you understand VIX. Now let's layer on a third thing. It's called VX futures. What is a future? It is just a contract for the future price of something. So imagine VIX futures expire in different months. So really what you're looking at is VIX a month from now, VIX 2 months from now, VIX 3 months from now. What does the price that you're willing to pay show that VIX should be at in 1, 2, or 3 months? That's all a future is. It's another contract. So this is why this is a turd onion, right? How many contracts do we have now? We have 2 derivative layers. Actually, almost 3, right? Because an index is a layer of something, first off, right? Then you have, does everybody know what the index is, right? It's just the S&P 5, it's just the 500 largest companies stack ranked and put into an index, and then they price it. Then that's one layer. Then you have the VIX is the price of the options relative to each other. So if puts are $20, then VIX is going to go up. If the relative value of the puts are $10, the VIX is going to go down. Then we have the third layer, which is the futures. We have another contract on top of another contract. So you're going to think of it as the future price in different months, right? Month 1, 2, 3. And so they're going to think of what they think VIX will be at. What do they think the fear of the market is going to be in month 1, month 2, and month 3? So VIX ranges from 0 to, historically speaking, 100 or 200. It stays anywhere most of the time between 10 and 30. So we're going to use those usual amounts. Now, during the crisis this year, I think it hit like 100? It was ridiculous. It hit 84, right? We'll say like in month 1, they think it's going to be 20. In month 2, they think it's going to be 22. And what do I mean they? It means the market, because price tells you something. Price is information. And maybe in the 3rd month, they think it's going to be 23. So what do you think they think about what the price of the S&P 500 is going to be in month 1 versus month 2, right? They think that in month 2, the price of XPX is going to go up or down. Down, thank you. Okay, down. Because the VIX price is going up, right? What did I tell you about these relationships? I told you when VIX goes up, S&P, right here is the answer. See that? When VIX goes up, the S&P 500 goes down. See, that is just that easy. Now, these are usual relationships. Obviously, we have a weird fucking market.
Say, they're speculative, right? Futures are speculative, right?
Absolutely. It can definitely not hold true to this, right? But in most of the time, this is how it happens, okay? Right? We're all pattern. We all look for patterns, right? What's the difference between a future and a call? They're both derivatives. They're both contracts, except they're both delivery. They're just slightly different. One is regulated by the CME, which is the futures. Calls are regulated by CBOE. A future can be cash settled. Actually, calls can be cash settled too if they're European options. They're American options. They can't be cash settled. They both can take delivery, They're just both derivatives. They may operate a little bit differently, but they're really similar. You can look up both of the contract specs. For futures, you can just say like VX future and look up the contract specs and it'll tell you all about it. Calls are leveraged too, Cypher. Calls and futures are leveraged. That's a great one. Thank you, Linux. American options calls can be exercised at any time. Futures only take delivery in the specified expiration date. And most of the time you can get more leverage out of futures. They're larger products. They're where the big boys play, for sure. Okay, so let's keep going. So what happens in month 3 if VIX is up again? What do they think XPX is going to do in month 3?
Down.
Thank you, Melinda. Just stick with me. Just think it's a contract. Just think that futures mean the future price of something. Literally like the word. Okay, because it is a shit onion. Finance is basically a shit onion. You need to understand a lot of things to understand simple concepts. So let go that you need to know everything. Just think of the simple thing that you need to, that's important, which is it's the future price of something. So now you have VX futures layered on top of that. So what we just taught you is called a term structure. A term structure gives you a lot of information about what the market is doing and they're thinking about. But the formal definition is debt is a bitch. If you were to graph these prices that I've given you along a line, so you would say month 1, month 2, month 3. So price would be on the x-axis, and the way that it would look like is, it would look like this. So if this was 25, it would look, right? Because this is 20, this is 22, 23. Okay, so you guys are literally being taught futures and term structure in little less than 10 minutes. So stick with me. Okay, so the shape of the line tells you something. Who's heard of Contango and backwardation? Shape of this line is called something. It's called Contango. So the shape of the line being like this is Contango. Backwardation is the other way. Is like that. Okay, so Contango is what you've seen. So all it's telling you is that the market thinks that they need to hedge for some reason. That's the way that you need to interpret a term structure that is in Contango. Why? Because they're buying up month 1 and month 2 options, right? Think about it, right? What did we do? What do you do if you see down movement coming? If you buy a 30-day option or a 30-day contract, that means you think sometime between now and month 2 that SPX is going to go down. If larger people are hedging, I take that information and I perceive more risk. When I see it really, really ping down, right, which is what we saw on, let's go to historical prices, and you can see backwardation that's really steep. What does steep mean? It's the difference between the first and the second month. So we'll show you how to use this tool. What was that, on the 12th? Yeah. Okay, remember the line that we showed you, right? It's really steep, right? Because the steepness of it can change. Look at how we go backwards in time. It gets less steep, right? See how this Contango percentage is changing all along the different months. Look, 7 months of hedging, or 7 months of contracts. See that? So we go back to the 12th, which is 21. So typically when I see Contango go above 20%, to me that's the Contango of the February contract and the March contract, which is month 1, month 2. I don't like it. Now, there's a lot of evidence out there that says the steepness of the line, either in Contango or backwardation, is predictive of the market. Now, it's less predictive when Contango is up. It is more predictive when backwardation. So what are you going to see backwardation when this number is negative? So Contango is positive, and backwardation is a negative number. Now, what does it mean in predictive? In statistics, all it means is that it's statistically significant, meaning that you can draw a conclusion from it. So all that means is it a Fugazi bullshit thing, or is it a real relationship, a real correlation? Did Contango form coming out of the March crisis last year? It did. It went above. It did. Fugazi? I take it from the Wolf of Wall Street movie when he goes, it's a word for him saying it's fake. You can go back in here and see what it did for different days. Maybe you want to see how it performed, right? And I'll be happy to put in the link in for YouTube, the description, the research that I did. I went to a bunch of academic journals to kind of pull out this information, and I'm trying to use it now. It's not something that I've used in the past. I've only used it. This will be my second time using it with real money. I will put in the description what the research that I've done is, but this is how I interpret it in a simple way, right? Next, what you would need to understand is how this plays into the products that I see you guys using to play volatility. So there's two products, VXX and UVXY. So these contracts, you can go look them up. You can just do \VX and you can see the current contract graph. Now the problem with this is this product is quite massive actually. It is about a $20,000 contract just to hold it, and that's only the margin. The contract is actually worth much more. If we look up the contract specs, which is how I told you, you can do with futures to see what they are and what the terms of this contract are. So remember I told you futures are, the contract multiplier for each VX futures contract is 1,000. This is almost $100,000 contract. So yes, you can hold it for the margin, which is only a small percentage of what the contract is specified for, but it's about $100,000 contract. So it's a really large contract, right? You can't size appropriately into your portfolio, right? Not a lot of us have giant portfolios where one position could be 100,000. So people buy these products because they can buy only 1,000 or 100 of something. Backwardation, extreme backwardation is assigned to instead that the price of SPY has some correlation that it will go up. Now remember, things are a probability, not a certainty, right? So you need to learn how to use a strategy to eke out like a 70% edge or whatever that is, right? If you guys want to see that, that's a different playlist. And I'm sure we'll have the card up here. So VXX is it's a fund of the VIX futures. Okay, are you with me? This is why this is a turd onion. How many layers do we have now? We have an index, which is one layer. We have VIX, which is the second one. So let's just start counting out the turd onionness, okay? So 1, 2, 3, 4th layer, okay? We'll talk again more about how to use it later, but we're just showing you guys. So VXX and UVXY are both layers in itself. So let's start with VXX. This is why you guys want, like, imagine how I have to explain things in one-word answers for all this shit, right? So VXX is a fund that holds VX futures. Now, I don't know the contract specs, but usually what they do is they hold a percentage of each month. So they'll hold like, I don't know, let me make up this number, 70% of the fund and 30% of the fund in month 2. So like, let's imagine that the whole fund is worth $100 million. 70% of that will be used to buy month 1 futures of VIX, and 30% of that will be used to buy month 2. And every day that as time elapses, they will change their allocation of the day, and they do some balancing here. okay, to account to accurately reflect this 70-30 split between different months. So every day the fund is making trades within this product. That's why it's a giant turd onion. What's disadvantageous to this product is if there's steep contango, you're paying something called roll yield, okay? Because what you're doing is effectively you're having to adjust, and if there is a difference, if month 1 and month 2 aren't the same price, you pay a roll yield, right? Because it's like when you adjust a losing position. Like today, let's say somebody decided to take a loss today because the market went down, right? To continue having 30 days of protection or whatever, you're going to have to rebuy the contract over and over again. So you can see in the tool, it does it really nicely for you. It doesn't show it on historical, but for current, it'll show you. See how it says roll yield right here? Do you guys see that? See the roll yield there?
Yeah.
It's decay. Yes, absolutely. That's how you should think about it. Thank you, Pick. It's decay.
Pick.
Remember, you guys are all used to holding options, and every day passes, and it's costing you money, right? But the cool thing about these products is there can be positive decay, especially when it goes into backwardation. So you can instead, when it's in backwardation, you can get paid to hold it. Contango is not 20% right now. It's like 10%. Just learn the market. It's not fucking rocket science, and you can start to profit. I'm not saying it's easy, but what will set you apart is your ability to sit through these explanations, to sit through and understand exactly what's being traded. You know, there are people who buy these things and have no idea what's going on. The turd onion is going to keep going, okay? So it's going to get even worse. Are you guys ready? What are we on, the fucking fifth layer now? Roll yield is a 5th layer, okay? We're going hard, boys. All right, next, the turd onion continues. So 6, the turd onion continues. If you go into UVXY, it's a leveraged product. What does that mean is they take, I think it's 2 times leveraged? I don't know. It's some factor. They apply margin, meaning it's just a fancy word for an IOU. They go get a loan and they double down on these VX futures. So instead of the 70-30 split that I showed you before, they're doing 70-30 split, but with borrowed money. And every day they rebalance, right? What does that mean? You're literally buying into almost a strategy, right? This product is not suitable for almost anybody. I mean, it is the riskiest shit I've ever seen in my life. It is not meant to be held overnight. It's for daily swings. But yes, they basically margin out this, okay? Are you guys ready for the next layer? Come on, tell me you want the next layer, because we're going to keep going, right? About the shit people don't know that they're buying. I've never seen people so willing to buy something they know nothing about. Okay, we're on the 7th fucking layer. The 7th fucking layer of this garbage is that the fund has an acceleration. Most of these funds, these leverage products, have an acceleration clause. What the fuck does that mean? They have the right to sell off the whole fund and blow it up if their margining blows up their account. You know when people blow YOLO and blow up accounts? You know that? Right? What happens to their account when people YOLO? Margin called, right? So if they get margin called, they have an acceleration clause. So this is in general, right? I'd have to go look at UVXY to see what the real clause is, but usually they have the right to close down the fund. And basically, so if you're in a position in that, let's say it's at $10, they can just close it and you're done. But we're not done there. You guys ready for the next layer? There's options on leveraged products. You can get options on the leverage product. Okay? Yeah, you could get 3-time leverage, but then you can get options on 3-time leverage. So it's just it's a new layer, right? So you guys know what options are. They're another derivative contract that requires the delivery of the underlying. And if the underlying blows up, what the fuck do you deliver? Number 9 is the last layer. Did you know you could get margin on all of this? Oh my God, it's not the last one. Ready for the 10th layer? I figured this shit out. So you could go get an IOU on this shit. Even more amazing is if you have around $100,000, you can go get this amazing thing called portfolio margin, which is 12 times leverage. I've seen people do this on the internet because the internet is insane. So they literally did all of this and they have no idea what it means. Okay, let me tell you about brokerages and how they collect money. They are the most savage motherfuckers I've ever seen. They will come to your house, sell all your shit. They will take your 401k. Please do not do this dumb ass shit. I am not a licensed professional. This is not a recommendation to buy or sell. You alone are responsible for your dumbass ideas. Don't have a gum moment, okay? Okay, and this is the turd onion that I wanted to explain to you about. As with any tool, right? You could have a jackhammer and you can, I don't know, fix your sidewalk because you re-put it down. But you can also jackhammer your foot and not have a foot anymore. So with any tool, there is probably a knowledgeable way to use it, and then there is an unknowledgeable way to use it. Okay, but we're all learning, so even I can get wrecked sometimes. AKA, there's always risk in every product, even from stuff that you don't know. So even about this stuff that I'm telling you, there may be tail risk that you don't know about. So with that, how did I interpret it? So what did I do on 212? On 212, I said VIX Contango went up to 212. I mean, to 20%. Positive, right? So what did I say? When it goes to 20%, I went to de-risk. So what did I do? I did 3 things. I have 3 strategies. And so it's going to be a lot. But in the short-term strategies, I about 50% liquidated. As SPY continued to come down, I liquidated even more, all the way up to 100%. 2 positions of those, or 20% of that, was done during. I will take half credit that on Friday I did liquidate half, but for those of you that are watching, I was in the middle of that Texas shit and I didn't have access to my phone to watch the market, so I liquidated the half of it. So half of it was I perceived risk, half of it was because of Texas. So that's one in the E-Trade account. Second, in the TD Ameritrade, I did not trade. I did not continue on the swaggy stocks. Again, this one was more predicated on Texas. And so we're going to cross that out as the VIX indicator. In the long-term account, because I don't fucking sell in the long-term account, although we might have to modify it to do momentum. But for now, what we did was we added UVXY calls. And they did not perform the way that I liked. So I did do part of the turd onion. So I bought 15 UVXY calls for 9.5 strike. Because my thought was, if we're going to have a huge dump, if UVXY calls would go up. Now, I did perceive risk correctly in that the liquidation of the short terms did benefit me because a lot of those positions got really bad. So now we're going into the second talk of appropriate hedges. Oh my God, I'm not spelling it right. Whatever. So what is a hedge? A hedge is something that rises in value when your position lowers in value. In other words, it needs to be negatively correlated, right? What it is it's protection. It's protection for your portfolio, so that way, because what did everyone do? is they freaked out today, right? Why? Because their portfolios are all down. Who doesn't have a down portfolio? My short terms are fine. Okay, so what are appropriate options for your hedge, right? So you need to find something that's negatively correlated. And I could leave the explanation there, right? Because it's always going to change as the market changes. Remember, I told you, I can't sell you a fucking course because this shit changes so quickly. Usually UVXY does fine, okay? In the crash earlier this year, when we were back testing what we thought would be a good hedge, it worked just fine. But in this situation, it's not. Now, we're not done because Contango isn't all the way, it hasn't gone negative yet. So the trade isn't done. But for right now, it's not performing the way we would have thought. So what's another appropriate hedge to potentially this portfolio? What do you guys think? Okay, so this is what you do. You think of ideas and then you go see the performance compared to it, you know? Well, commodities is more of a hedge of inflation. I'm talking about SPY going down. So that's another way to do it. Nampoku points up an important concept, which is rotation. You can just rotate into different assets. So Byte brings up another one, which is puts on the specific position, right? So I could have gotten Tesla puts, right? Those perform pretty well. So I'm going to cross out UVXY options were a bad idea in this instance. So what we need to do is continue to evaluate the hedges and see how they perform and how you want them to perform in different scenarios. Obviously, all this stuff has, people can't give you answers because the market changes all the time, right? I would have thought UVXY calls would have been fine. And look at me, right? We're staring at a position that is, where's the UVXY? It's down 1,000. It was supposed to protect the whole portfolio and it didn't. How do you win? Well, not losing money is winning. I consider that liquidating that E-Trade account as winning. How is crypto a hedge? I think it's only really a hedge for inflation, which is what I said back then. I think it's anything can be a hedge. That's the point. It just needs to be negatively correlated to the thing that you're trying to hold, right? So if I'm holding, there's basically these things that you can run to see what's negatively correlated to your product. Anyway, so you can go here. I don't know your other tools that you're using, but it's something that you can run. So let's say for Tesla. So we're going to go to opportunities, and what it's going to do is it's also going to compute hedges because that's the appropriate way to trade. Now, look, correlated markets, uncorrelated hedges, right? So it's telling you that all it found was VIX and VXX was correlated, was supposed to be a hedge. But see, it didn't work this time at all. It didn't fucking work. That's a bad hedge. That's 0.3. You need something that's way more negative than that. VIX isn't even up from fucking Friday. So do you see why nobody can give you a course? That's why when everybody says, oh, I sold you a course on how to trade, and I'm like, with the exact strategies. Oh, God, okay, guys, I'm the fucking lame ass. I've sold you. Buy my course that's $2,000 that'll show you the exact strategies I use to profit every day. Garbage. You can sell cover calls to hedge a little bit and recoup some premium. Yeah, that's a good idea. Cover calls are a bad hedge just because if you look at a P&L graph, it's only like a little bit. Maybe that's all you want to hedge. You just want to hedge a little bit. But remember, you're also capping off your... reason why I don't like it is because you're capping off the infinite profit that a stock has, right? I would rather, I don't like it. Just don't. If we're looking at asymmetric win-reward ratios or win-reward like opportunities, right? Meaning you can win $10 for the price of $1, right? If you do a covered call, you're basically selling all that upside. So now you're at like buy a $1 bet for maybe you get out 50 cents out of it. You know, it's tough to have outperformance with that kind of gain and loss. You know what I mean? In the courses, basically, because they're not showing you where the market is currently, what they're basically doing you a disservice is that they're giving you such generic information that it's very difficult to get to that generic information to what the fuck am I actually going to do? Why do you guys think I'm on Twitch? It's because it's about the daily bullshit you guys are going to experience and all of us going through that together. It's about practicing what you preach, right? It's about the practical application of all of us going through this fucked up market. Who knew gold was going to be fucking correlated to SPY? That's fucking weird. Well, Gatto, you're pointing out that hedges, it depends on your time period, Gatto. Right? Maybe you're looking at on a 1 minute chart and crypto doesn't exactly follow a correlation against hedge. But remember, inflation is something that's so slow. Okay? Inflation happens over multitudes of years, right? So you may need to zoom out on crypto. Gold is, see, this is why I can't sell you a course, because gold is usually a hedge against the market. And recently it's been very correlated. So this is what you guys need to understand. The direction of something is not correlation. Maybe I need to go back to that because you guys see gold go up. It has to move with it. If it goes down and then eventually up, back then it didn't really move with it, right? It's about, that would be a positive correlation. If it's negative correlation, it would be exactly opposite. Like you take the high road and I take the low road. It's about both of them, not one. So let's run a correlation on, it's so hard to talk about math. But that's basically what you're asking people to do. Like I observe everyone go after financial education and no one wants to do the math, right? So instead they ask people for rules of thumb, like as if rules of thumb made anybody a ton of money. So let's run a correlation, right? How the fuck do you know that it's a good hedge or not, right? VIX and SPY negatively correlated about 0.6. But look, the correlation, negative 0.6. The correlation was much better in September. Remember, I picked UVXY as an appropriate hedge, right? Well, look, the hedge got worse. Better here, worse. Better in September, worse in fucking right now, which is exactly what we're experiencing. And probably high roll yield, yeah. Yeah, correlations change. That's why nobody can fucking, that's like, yay, he realizes it. Oh, I just need one person to realize it. Thank you so much, Quigley. Thank you. You have made my fucking day. Yeah, gold, they all change. So now it's not as strongly correlated. Yeah, that's what, I already know that because UVXY isn't protecting my portfolio. VIX isn't protecting my portfolio. I can see it. Once those light bulbs start to hit in here, you guys will all realize that I seem prescient and I don't. I have tricks. You just need to know this basic shit. And yes, I'm sorry. It is basic for finance people. And that's what's so fucked up and why they make so much money off of you is because they don't explain it like this. They don't want you to know. It makes sense for businesses that change, but I wouldn't expect it for VIX, with VIX. Why? VIX is just the behavior of people. Do you think the behavior of people don't change? We saw that this year, right? Everyone used to go out and travel a lot. What do they fucking do? Don't do that now. People change. The VIX is just the market buying VIX. Why wouldn't the market change? If the market was the same all the time, I could print infinite money for you. That's the hard part that you guys have decided to learn about. Business is easy compared to this shit. Fuck that. Look at this. In fucking a month it changed. Tell me a fucking business that's changed in a month that doesn't do it all the time. I mean, yeah, meme stocks and short-term trading change really quickly, but long-term shit doesn't.
Yep.
Byte said, is it possible to determine why VIX UVXY is not a good hedge in this case, to learn from it and how to tell in the future? That's the fucked up thing about the market, is you don't know until you know. You're asking me, can anyone actually predict the future, basically? No. You learn things about the market as it goes.